Over the course of 11 episodes, we have traced the agonizing journey of an electron trying to reach a GPU. We have dug copper out of the ground, we have waited in line for transformers, we have battled the transmission grid, and we have plumbed the liquid cooling inside the data center.
We have looked at every piece of hardware and every ounce of metal required to turn the $2 trillion AI backlog into physical reality. But there is one final, crucial entity we have not yet discussed. The entity that actually owns the power plant, holds the keys to the megawatt, and signs the contract to sell the electricity.
Welcome back to the Working Thesis. Today is a milestone. We have reached the final episode of the AI Power Problem series. We are looking at the merchant power sellers, the final link in the chain, and the last stop on our journey.
We are going to explore how a sector once considered the most boring corner of the market suddenly became the epicenter of the AI boom. And we will look at the specific deals that are redefining the future of energy.
Quick, honest note before we dig in. This is just two curious people thinking out loud for learning and for fun. It's not investment advice and never a buy or sell call. So always do your own homework. To understand this sector, you have to understand what an independent power producer, or IPP, actually is. Often referred to as merchant generators, these are companies that own and operate power plants and sell electricity on the wholesale market.
They are different from your local, fully regulated utility that owns both the power plant and the power lines running to your house. IPPs operate in deregulated markets, meaning they have to compete to sell their power.
For years, this was considered a relatively sleepy, low-margin business. You generate electricity, you sell it to the grid, and you hope the price is high enough to cover your fuel and maintenance costs.
But the AI revolution changed the math overnight. Suddenly, the hyperscalers, the massive cloud providers, desperately needed firm, dispatchable, 24/7 power, and they needed it by the gigawatt. And the only people who held the keys to that kind of power at scale were the merchant generators. They went from boring utility to AI power growth practically overnight.
The surge in AI demand has created two massive macro tailwinds that are lifting the entire merchant power group. The first tailwind became incredibly visible during a recent capacity auction in the PJM market.
PJM is a massive regional transmission organization that coordinates the movement of wholesale electricity in all or parts of 13 states and the District of Columbia. Crucially, it includes Northern Virginia, the data center capital of the world.
PJM holds auctions to ensure there is enough power generation capacity available to meet future demand, and the 2026-27 auction cleared at the FERC price cap, about $329 per megawatt day.
That is a stunning number. It is up roughly 22% year over year and represents a multi-100% jump over the last 2 years. The data centers drove the majority of that demand increase, and the grid cleared with only about 139 megawatts of capacity above the absolute reliability minimum. The margins are razor thin.
For merchant generators, that clearing price is a structural revenue windfall. But there is a flip side to this. Retail electricity bills are rising a few percent as a result. That affordability tension is fueling a political and societal backlash that the industry will have to watch very closely. The second macro tailwind is the push for co-location. This is the key regulatory swing factor for the entire sector. Can a data center plug directly into a power plant behind the meter, completely bypassing the public grid?
In late 2024, the Federal Energy Regulatory Commission, or FERC, rejected a high-profile behind-the-meter arrangement between Talen Energy and Amazon. FERC cited concerns over grid reliability and cost fairness for regular ratepayers.
As a result of that rejection, the industry pivoted. Deals shifted to front-of-the-meter arrangements, meaning they connect through the grid, which avoids the need for specific FERC co-location sign-off, but adds grid fees and complexity.
But the co-location story isn't over. FERC is still weighing standardized rules for these types of connections. A favorable ruling in the future could re-rate the optionality of direct nuclear to data center deals. An adverse ruling caps that specific business model. It is the single most important regulatory decision to watch in the AI power space right now.
To see how these dynamics play out in the real world, we can look at a few illustrative examples of the companies actually signing these deals. Again, These are industry newsmakers serving as examples, explicitly not recommendations.
Let's look at Constellation Energy as an example of pure scale. In January 2026, Constellation closed a roughly $16.4 billion acquisition of Calpine. That deal made the largest U.S. clean generator the largest U.S. electricity producer overall.
The combined entity controls about 60 gigawatts of capacity. They blended their massive nuclear fleet with Calpine's natural gas and geothermal assets. The result is exactly the 24/7, clean plus dispatchable power mix that hyperscalers are desperately searching for.
They are also the company famously working to restart a reactor at 3 Mile Island, rebranded as the Crane Clean Energy Center under a 20-year power purchase agreement with Microsoft. It is the ultimate example of a merchant generator leveraging its existing, massive footprint to serve a single hyperscaler.
Another illustrative example is Vistra. They represent a dual-fuel approach, operating a massive mix of natural gas and nuclear assets alongside a retail business, primarily across the ERCOT market in Texas and the PJM market.
Vistra has been aggressively signing deals. They secured multi-gigawatt nuclear power purchase agreements with Amazon at their Comanche Peak plant, and with Meta within the PJM footprint.
At the same time, they are locking in nuclear PPAs. They are aggressively expanding their gas fleet. They recently moved to acquire Cogentrix, adding about 5,500 megawatts of gas generation for roughly $4.7 billion.
And to secure their nuclear baseload well into the future, the Nuclear Regulatory Commission, the NRC, recently extended the operating license for the Comanche Peak plant by another 20 years, pushing it out to 2053.
Finally, we have Talen Energy, which provides a fascinating example of high-torque, single-asset leverage. Talen operates a natural gas fleet in PJM, but their crown jewel is a single, massive nuclear plant called Susquehanna, which generates about 2.5 gigawatts of power.
Talen is the company at the center of the signature co-location debate. They signed a 17-year, roughly $18 billion PPA with Amazon for up to roughly 1,900 megawatts of carbon-free power from that plant.
That is the exact deal we mentioned earlier. The one that was restructured from a behind-the-meter arrangement to a front-of-the-meter arrangement after FERC's initial rejection.
Because so much of their AI strategy is tied to that single, massive asset and that specific deal structure, they represent the purest, most direct exposure to the ongoing regulatory debate surrounding co-location and grid access.
Just like we discussed with the physical inputs in episode 11, it is a huge mistake to lump all these merchant generators together. They have very different asset mixes, different signature deals, and entirely different risk profiles.
You have the massive scale and clean baseload of a Constellation. You have the dual-fuel capital return machine of a Vistra. And you have the single-asset regulatory torque of a Talen.
And we have to be honest about the two-sided reality of this sector. The bull case is clear. They own the power that AI desperately needs. But the bear case is that these stocks have already re-rated enormously off their 2023 lows. Many have become multi-baggers as the market digested the AI demand shock.
The easy part of the trade, the initial realization that power is valuable, may be behind us. From here on out, it is all about execution. It is about actually delivering on those massive PPAs, managing the political backlash of rising retail bills, and navigating whatever FERC decides on co-location.
Which brings us to the end of the line and the end of our series. Let's take a step back and look at the complete chain we have mapped out over the last 12 episodes.
We started with the sheer scale of the demand, the $2 trillion AI backlog sitting in the cloud in episode 1. In episode 2, we realized that the backlog was hitting a physical wall, proving it was a power problem, not a chip problem.
From there, we explored America's grid problem and the massive interconnection queues in episode 3. We looked at the humble transformers in episode 4 and the frantic scramble to build natural gas bridges right now in episodes 5 and 7.
We explored the ultimate destination of the nuclear question in episode 6 and met the bottleneck kings selling the heavy gear in episode 8. We looked across the ocean to understand China's secret power edge in episode 9, and then went deep inside the data center to tackle last-mile liquid cooling in episode 10.
Finally, we dug into the Earth to find the physical inputs, the copper, aluminum, uranium, and steel, in episode 11 before arriving here today with the power sellers who actually own the megawatt.
The grand synthesis is simple. Every single link in that chain is a bottleneck.
The through line of this entire 12-part investigation is that the binding constraint of artificial intelligence has moved. It has left the world of silicon and software and firmly embedded itself in the physical world.
The bottlenecks we have identified are real. They are physically non-substitutable, and they are agonizingly slow to fix. You cannot code your way out of a transformer shortage or a copper deficit.
We have learned that capital will flow to whoever owns this scarce layer of the ecosystem. But we have also learned that every one of those layers is cyclical, heavily regulated, and priced with incredibly high expectations. And as history shows us, the physical world rarely rolls out perfectly on schedule. Although we have mapped the chain, the story is far from over. We are leaving you with massive, unresolved questions that will dictate the next decade of technology.
Will FERC's final co-location rules unlock direct nuclear to data center power? Or cap it forever? Will small modular reactors actually arrive in time to matter? Will the political backlash over rising electricity bills halt the data center boom in its tracks?
And perhaps the biggest question of all, will AI efficiency, models doing more math with fewer tokens and vastly cheaper inference, eventually ease the power crunch? Or will the demand just broaden, relocate, and keep growing to consume every new gigawatt we can build?
We are midstream in this transition. The demand is broadening, not slowing. And the answers to those questions are being written in real time by the companies and regulators we have tracked.
And with that, we close the book on the AI power problem. To everyone who has followed us from the $2 trillion backlog all the way down to the copper wire, thank you.
At its heart, this has been a story about the slow, heavy physical world racing to catch up with a blindingly fast digital dream. It is a race run on clocks measured in years and decades, not in software sprints.
The theme of AI and infrastructure will continue to evolve, but this specific journey, mapping the complete chain from the promise to the plug, is complete. For The Working Thesis, I'm Maya.
And I'm Theo. The physical limits of the digital mind are now mapped. Thank you for watching. Okay, that's our episode. The honest goal here is simple. Hold a few ideas about the world and keep checking whether they're still true.
Together, out loud, a little at a time. If you spot where we've got it wrong, please tell us. That's how this gets better. See you next time.